Welcome back to the deep dive. Today we're focusing on the seconds that changed everything, a critical pivot point in history that really defined the economic world you and I are living in right now.
We are. We're strapping in for what were probably the most consequential 48 hours in modern financial history. We're going inside the pressure cooker of the 2008 crisis.
And we're zeroing in on a single, incredibly tense moment, the final hours of Sunday, September 14th, 2008.
That specific Sunday night, yeah. It all came down to a single phone call.
The phone call that sank a Titan. It's the moment that the global financial crisis, it turned from being a series of bad bets into a full-blown systemic global economic catastrophe.
Right. So our mission today is to take this whole stack of sources, the official FCIC report, the memoirs from Paulson and Bernanke, the academic critiques, and really just distill what happened.
Exactly. Who was in the room? What was the decision? And how does that one choice still shape our world a decade and a half later?
And we know exactly where this all goes down. 33 Liberty Street in New York City, the Federal Reserve Bank of New York, this sort of imposing granite fortress that became the war room for the global economy.
You really have to paint the picture. It's late Sunday night, it's pushing towards midnight, even 1 in the morning, and the atmosphere inside is just toxic with exhaustion.
Stale coffee, I'm sure.
Oh, absolutely.
Yeah.
For 48 frantic hours, the most powerful men in finance, we're talking Treasury Secretary Hank Paulson, Fed Chair Ben Bernanke, and New York Fed President Tim Geithner, they have been locked in these emergency meetings.
Their clothes are rumpled, their resolve is completely frayed, and their one single job is to find a solution for Lehman Brothers. Fast.
And the stakes were just astronomical.
Yeah.
And I think the failure to really grasp those stakes is so central to this story.
I mean, we're not talking about some small firm. This was a 158-year-old institution, a cornerstone of Wall Street.
And its size was staggering. At the time it filed for bankruptcy, Lehman Brothers had well over $600 billion in assets.
Which was more than 3 times the size of Bear Stearns, which they had just bailed out 6 months earlier.
And over 25,000 employees all over the world. It was by far the largest bankruptcy in U.S. history.
Yeah.
But the real threat wasn't just to its own employees, was it?
No, not at all. The threat was to the very functioning of global commerce. That's what they were afraid of.
That sheer magnitude is key. So we've broken this deep dive into 3 clear acts so you can follow the narrative flow precisely. First, we have to understand the pressure cooker.
We'll look at how political constraints and really the ghost of a past bailout tied the hands of the decision makers, made them, reluctant to act.
Then Act 2. We will stand in the room for the fulcrum moment. That chaotic weekend where a last-minute rescue deal fails because of one single critical refusal between regulators.
And finally, Act 3, the flood. The immediate cascading consequences that just unleashed chaos and defined the economic world we all inhabit today.
Okay, so let's start with Act 1, the pressure cooker.
To understand the no that ultimately doomed Lehman, we really have to rewind just 6 months. To another frantic weekend, this time in March of 2008.
This is where we get the ghost of Bear Stearns.
Exactly. The ghost of Bear Stearns was born right there.
Okay, so wait. If they were so worried about systemic risk in September, how did they handle Bear Stearns back in March? I mean, wasn't that the initial mistake that created the problem later on?
Absolutely, 100%. The decision to save Bear Stearns created this massive, massive contradiction.
So what happened? Bear Stearns was facing collapse.
It was a classic liquidity crisis. Their funding had dried up. So to prevent a systemic panic, the Fed orchestrated its acquisition by J.P. Morgan Chase.
But the government had to get involved, right? It wasn't just a private deal.
Not at all. And this is the crucial part. The government provided a special lending vehicle backed by $29 billion in government funding, specifically to absorb Bear Stearns' most toxic and illiquid assets.
So they used public money. They effectively guaranteed the outcome to get a private sale over the line. What message did that send to the rest of Wall Street?
The message was loud and clear. It was unambiguous. There was a government-sponsored insurance policy for the largest, most interconnected firms.
The idea that some firms were too interconnected to fail.
Exactly. And for an aggressive CEO like Lehman's Dick Fuld, who, had this reputation for arrogance and never listening to outside advice, this was taken as gospel.
Right. And according to accounts from insiders and the later government investigation, Fuld saw the Bear Stearns rescue as an ironclad precedent. He truly believed the government would never, ever permit a firm of Lehman's size to fail.
And that belief, that conviction that the government backstop was guaranteed, it created the perfect environment for what economists call the moral hazard dilemma.
Right, moral hazard. The idea that if you protect someone from the consequences of their actions, they're just encouraged to take even bigger risks.
Precisely. It's the dangerous belief that being protected from failure encourages more failure.
So if Dick Fuld genuinely believed the Fed would save him, then there was no urgency. No reason to address the massive glaring problems that were piling up on his balance sheet all through the spring and summer of 2008.
Why would there be? Why sell your assets at a loss right now if you think the government is just going to step in and give you a better deal later?
He thought time was on his side.
He did. And the reports and memoirs all highlight this. Lehman's leadership, operating completely under this assumption, they resisted selling assets at these, fire sale prices that might have actually stabilized the firm.
They just kept operating with this dangerous confidence, essentially betting the whole company on the government being willing to rescue them a second time.
And they just fundamentally misread the politics in Washington. They misread the government's ability and, more importantly, its appetite to intervene again.
So moral hazard created a huge behavioral problem. But that behavior was only fatal because of Lehman's underlying weakness.
Exactly. The behavior was the trigger, but the gun was already loaded.
Let's tackle the common misconception here. We often hear about complex financial derivatives, credit default swaps, but what was the foundational business failure that actually killed Lehman?
That is such a vital point to clarify, because while Lehman's derivatives book was massive, they were, counterparties on countless credit default swaps. That wasn't the root cause.
Oh, what was?
The primary cause of failure, confirmed by every serious analysis, was just old-fashioned banking mismanagement.
Meaning what specifically?
Excessive leverage and massive illiquid investments in commercial real estate.
Leverage, meaning they were borrowing huge amounts of money against their assets to juice their returns.
Huge amounts. And can you elaborate on the scale of their real estate exposure? Because it was breathtaking.
By late 2007, Lehman had nearly $100 billion tied up in commercial mortgages, construction loans, and all the associated securities. These incredibly complex investment vehicles.
And they'd been wildly successful for a while. They posted a record $4.2 billion net income in 2007. They were riding that real estate wave as high as it would go.
But when the housing market finally crumbled, and everyone realized these assets were basically impossible to sell, those highly leveraged holdings became catastrophic liabilities.
Liquidity just vanished instantly.
The speed of that reversal is just stunning, from record profits in one year to total collapse the next. And that really brings in this element of corporate culture and hubris.
Yes, the culture was a huge part of the problem. Some of the research, like Vicky Ward's work, paints this picture of a toxic environment of greed and arrogance inside Lehman.
And it all started at the top with Dick Fuld, right? They called him the gorilla.
They did. He fostered this fiercely loyal but incredibly insular culture. So when the danger signal started flashing, any external advisors who came in and said, hey, you have a problem, they were just dismissed.
There was this institutional arrogance, a belief that Lehman was just fundamentally smarter and more powerful than the market forces that were lining up against it.
And that hubris, it prevented them from taking the painful steps they needed to take earlier in the summer, like raising more capital or aggressively selling off those bad assets.
They waited. They delayed until the political window for a rescue had slammed shut.
And that window closed specifically because of the political vice that was squeezing Treasury Secretary Paulson. The government's hands weren't tied by a lack of money. They were tied by politics. And the timing was just brutal.
The timing was everything, wasn't it? Just 1 week before the Lehman weekend, on Sunday, September 7th, 2008, Paulson had been forced to execute this massive, unprecedented nationalization.
Fannie Mae and Freddie Mac.
The two giants that guaranteed, roughly half of the entire $12 trillion American mortgage market?
That intervention was absolutely necessary to prevent the immediate collapse of housing finance in the U.S.
But that action, the largest government intervention in financial markets in history, it completely consumed all of Paulson's political capital.
All of it. Remember, he was a former CEO of Goldman Sachs. He was already deeply mistrusted by Congress and the public, and now he had just committed trillions in potential taxpayer liabilities to bail out these mortgage giants.
You can just imagine the outrage in Washington. He was being called Mr. Bailout on cable news.
He was. And according to his own memoir, On the Brink, Paulson was just incredibly frustrated. He knew he could not do what they did for Bear Stearns again.
With a presidential election just weeks away, The idea of using taxpayer money to save another investment bank.
Especially one that was seen as being run by these arrogant Wall Street
It
financiers.
wasn't just difficult, it was, as he put it, politically radioactive.
Yeah.
The administration just could not survive another rescue.
So this is the crucial context for that weekend. This is Act 1. The government was constrained not by lack of money, but by pure political reality, and by this perceived public mandate to finally introduce some discipline and stop moral hazard.
And that one constraint defined every single negotiation that followed. Which brings us to Act 2, the fulcrum moment.
That political constraint was the non-negotiable term of engagement when the final countdown began on Friday, September 12th.
This is the weekend war room. The scene inside 33 Liberty Street must have been just unbelievable.
It was completely unprecedented. The New York Fed president, Tim Geithner, he basically commanded the CEOs of all the rival banks, Goldman Sachs, JP Morgan, Morgan Stanley, to the Fed's headquarters.
He was forcing them to find a private solution, to save one of their own.
And implicitly threatening them with what would happen to all of them if they failed, the systemic consequences.
So the message from Paulson and Geithner was blunt. Wall Street, you have to find a private buyer for Lehman, and the government will provide no public backstop, no guarantee.
They were trying to force private capital to absorb Lehman's toxic assets. They worked around the clock through Saturday and into Sunday.
The tension must have been incredible. You have lifelong business adversaries, men who spent their whole careers trying to destroy each other, locked in conference rooms.
Eating ordered-in Chinese food, trying to hammer out this multi-billion-dollar agreement to save the system.
And this whole gamble, it hinged on finding a committed buyer. And for a little while, it looked like they had one. Bank of America was the leading suitor.
For a time, yeah. But in this stunning pivot, which is captured in incredible detail in Andrew Ross Sorkin's book Too Big to Fail, BofA just suddenly walked away late on Saturday night.
It was a brutal blow.
Yeah.
The CEO, Ken Lewis, he had a choice. He could buy the messier, much bigger Lehman, or he could buy the slightly smaller but much cleaner Merrill Lynch, which was also starting to crack.
And he chose stability over complexity. He went for Merrill Lynch instead.
The official announcement was held until Monday morning, but the knowledge that Lehman had been completely stranded, that it had no buyer, that just circulated instantly inside the New York Fed.
And the search for a new buyer became absolutely desperate.
The clock was running out. Markets in Tokyo would be opening in just a few hours. And it's here, in the final agonizing hours of Sunday, that we get the Barclays lifeline.
Yes, a potential savior emerges from across the Atlantic. Barclays, the big British bank, led by its American CEO, Bob Diamond.
And Diamond saw a huge opportunity, didn't he? He wanted to acquire the healthy parts of Lehman.
The good stuff. The lucrative trading desks, the institutional client networks, the prime New York real estate, and he wanted to leave all the toxic real estate debt behind for the old company to deal with.
For the exhausted regulators in New York, this must have felt like salvation. This was the private sector solution they had been demanding. A major global bank was ready to step in.
A global catastrophe was, literally averted by inches. It was that close.
But then came the fatal condition, the one thing that broke the entire deal.
The problem wasn't in New York. The problem was in London. The purchase was massive, and British regulators, the Financial Services Authority, or FSA, they were watching this American meltdown with intense apprehension.
So why did the FSA object? What were their specific concerns?
They had two huge concerns that were absolute deal breakers for them. First, an acquisition of that size, impacting a publicly listed UK firm like Barclays, it required a shareholder vote, and that would take weeks.
They did not have.
Not even close. They had hours. Second, and this was the critical point, the FSA refused to let Barclays absorb what they saw as a potentially poisoned American firm without a guarantee.
A guarantee for what?
They were terrified of hidden legal liabilities or, trading obligations, derivatives, counterparty agreements that might suddenly emerge right after the deal closed and blow a hole in Barclays' balance sheet.
So the FSA basically told Barclays, you can do this deal and you can bypass the shareholder vote, but only if the U.S. government provides a financial guarantee to cover those specific unknown liabilities.
Exactly that. They wanted an assurance that if a $10 billion hole suddenly appeared in Lehman's trading book on Monday morning, the U.S. taxpayer, not the UK banking system, would be the one to cover it.
And this request for a multi-billion-dollar guarantee landed directly on Treasury Secretary Paulson's desk.
This was it. This was the absolute moment of truth.
Paulson had staked his entire political identity, the government's credibility, on this no public money principle. It was born of political necessity and this real desire to finally combat moral hazard.
And he held firm. He did not blink. The refusal was delivered via a transatlantic phone call. Paulson told them he could not legally and politically provide that guarantee.
And the British regulators stood their ground. They vetoed the deal.
They did. The decision to save the global financial system hinged on Paulson's unwillingness, or maybe his inability, to commit public funds to backstop Barclays against Lehman's unknown debts.
That single refusal, just hinging on this one exchange between regulators across the Atlantic, it sealed Lehman's fate. If Paulson had relented, if he had treated Lehman like he treated Bear Stearns, the old domino effect might never have started.
Which brings us right to the heart of the legal and political debate that still rages to this day. Was Paulson's refusal a necessary legal step, or was it a massive, avoidable policy mistake?
The official rationale, which has been remarkably consistent from all the key players, Paulson, Bernanke, Geithner, is that they simply lacked the legal authority to intervene.
Right. They argue that under the Federal Reserve Act, the Fed is only allowed to lend to institutions that can post sufficient collateral to secure the loan. You have to protect the taxpayer.
And in his book, The Courage to Act, Bernanke states very clearly that Lehman did not have enough good collateral to secure the size of the loan it would have needed.
So in their view, providing the loan would have been an illegal act. It would have risked taxpayer money without adequate security. That's their story.
But this is where the detailed academic counterargument comes in. We have to introduce the economist Lawrence Ball and his deep dive, The Fed and Lehman Brothers.
Ball's work is fascinating. He directly challenges that official narrative. He presents this meticulous analysis of Lehman's financial statements from right before the collapse.
And what does he find?
He contends that the bank did possess sufficient quality assets that were not already pledged to other creditors that could have been used as collateral.
So Ball is arguing that the Fed could have structured a loan to prevent a disorderly bankruptcy, just like they did for Bear Stearns. They just would have had to be willing to accept a broader range of collateral or, structure a more complex deal.
Precisely. Therefore, according to Ball and other critics, the decision wasn't a strict legal necessity because of a lack of collateral. It was a profound policy choice.
A choice heavily influenced by Paulson's political constraints and this overwhelming desire to impose market discipline.
Even if it meant risking systemic instability. It's that tension between political reality and financial mechanics.
And the Financial Crisis Inquiry Commission, the FCIC, their report later criticized this inconsistent handling, saving Bear Stearns but not Lehman. They said it was a key factor that just fueled market uncertainty and panic.
Geithner wrote in his book, Stress Test, that they had no good options available. But the choice they made was the one that avoided political fallout, not necessarily the one that avoided a systemic meltdown.
So by late Sunday evening, with the Barclays lifeline officially dead, the decision was made. The phone call goes to Lehman's board. The government would stand aside.
That moment must have been just crushing. At 1:45 a.m. on Monday, September 15th, 2008, Lehman Brothers Holdings, Inc. filed for Chapter 11 bankruptcy.
With $639 billion in assets, it was the largest U.S. bankruptcy filing ever. It dwarfed everything that had come before.
And the initial market response was just immediate and brutal. When markets opened, Lehman's stock plunged 93%. But that stock market collapse, which dominated the headlines, that was only the symptom.
The real damage was happening somewhere else.
It was happening in the opaque technical plumbing of the global financial system.
Okay, so that brings us to Act 3. The flood. The decision not to intervene was like a dam breaking, and the floodwaters rushed straight into the markets that finance the real economy.
This is the domino effect, breaking the buck. If you really want to understand the true impact of Lehman's failure, you have to look past the stock market and into the commercial paper market.
Explain that. Why is commercial paper so vital, not just for Wall Street, but for the general economy?
The commercial paper market is basically this circulatory system for the global economy. It's where big corporations get short-term, unsecured loans, IOUs, basically to finance their immediate needs.
Like what?
Inventory, payroll, paying off other short-term debt. Companies you've heard of, General Electric, Ford, even your local utility, they all rely on these overnight loans to keep their day-to-day operations running.
So if that market freezes, the whole system of corporate credit just stops.
It grinds to a halt. And the money for this borrowing comes primarily from money market funds.
Which most people think of as being ultra-safe. basically the same as cash in a savings account.
They're built on this sacred, inviolable promise. The net asset value, or NAV, of the fund must always be $1. $1 in, $1 out. Always.
So what happened when Lehman failed that shattered that promise?
The panic mechanism started with a fund called the Reserve Primary Fund. It was one of the oldest and largest money market funds in the country, and it held a significant amount of Lehman Brothers commercial paper.
So when Lehman filed for bankruptcy,
That paper suddenly became worthless.
the value of the fund's assets dropped below the value of what it owed its investors.
Exactly. The Reserve Primary Fund could no longer guarantee that $1 return. Its NAV fell to 97 cents. This is what's called breaking the buck.
And that sacred promise was shattered.
For the first time in 14 years. And this wasn't just a small loss for investors, it was a huge psychological event. It implied that money, even money you thought was totally safe, could just vanish.
The fear must have been instantaneous and global.
It was. This news triggered a silent digital bank run across the entire world. Corporations, cities, institutional investors, they realized their cash wasn't safe in these funds. They started pulling hundreds of billions of dollars out within hours.
And since the money market funds are the primary buyers of commercial paper, that market just seized up.
Froze solid. The ability of major non-financial companies to get an overnight loan to make payroll or buy supplies it vanished. The financial plumbing of the world economy was clogged.
Bernanke wrote later that they had unleashed the nightmare scenario they had desperately tried to avoid.
And the chaos from that Lehman decision led directly, almost immediately, to the stunning reversal. Just hours after Lehman filed, all eyes turned to AIG, American International Group.
AIG wasn't a bank, though. It was a colossal insurance company. Why was its collapse even more terrifying than Lehman's?
Because AIG was fundamentally different. Its role was in the shadow banking system through its financial products division in London. They had sold hundreds of billions of dollars worth of credit default swaps.
Essentially, insurance contracts on the value of subprime mortgage assets.
Exactly. They were insuring financial instruments held by every single major bank in the world. So if those mortgage assets failed, AIG had to pay out huge sums to the banks it insured.
And when Lehman went under, confidence evaporated. Everyone assumed all these mortgage securities were worthless.
That's right. And that triggered the terms of all those CDS contracts. AIG's counterparties, the big banks in Europe and the US, they all demanded massive amounts of collateral immediately.
And AIG couldn't pay.
They couldn't meet the demands. It rendered them instantly insolvent.
So AIG was the counterparty to everyone. If it failed, it would have meant simultaneous defaults at almost every major bank in the world.
Its interconnectedness made Lehman look tiny. If AIG failed, the systemic domino effect would have been total. It could have crashed global trade and finance entirely.
And Paulson and Bernanke suddenly faced a catastrophe far, far worse than Lehman, a scenario that threatened the Second Great Depression.
And this is the ultimate bitter irony of that weekend. Only 48 hours after Paulson had held firm on the principle of moral hazard for Lehman.
He and Bernanke were forced to abandon that principle completely to save the entire system.
On Tuesday, September 16th, the U.S. government announced an initial $85 billion loan to rescue AIG. It was quickly followed by hundreds of billions more. This was a direct, massive government intervention.
The very thing they'd refused to provide just days earlier.
And that decision to rescue AIG proved beyond a shadow of a doubt that letting Lehman fail wasn't some calculated move to teach the market a lesson. It was, as the sources clearly document, a catastrophic miscalculation of systemic risk.
They thought they were eliminating one bad player, but they accidentally pulled the trigger that brought down the entire house of cards.
And this stunning reversal is the starting point for the enduring legacy that we are all still grappling with today. The great paradox of moral hazard.
Let's analyze that paradox. The government tried to cure reckless behavior by sacrificing Lehman, but that sacrifice unleashed a contagion so terrifying that it forced them to guarantee the entire system through AIG and later TERP.
The attempt to prove that no bank was too big to fail ended up cementing the fact that some institutions and the system they were part of were, in fact, absolutely too big to fail.
And it fundamentally redefined the relationship between Washington and Wall Street.
The political and financial fallout was immense. That panic led directly to the chaotic passage of the Troubled Asset Relief Program, TARP, on October 3rd.
Where Congress essentially had to write a blank check to save institutions the public absolutely despised. It fueled so much populist anger.
It did. And the need for TARP, which initially authorized $700 billion, flowed directly from the fear generated in that Lehman week. The crisis had moved beyond just liquidity. It was a crisis of confidence and solvency.
And the consequences weren't just in the financial sector. The Great Recession that followed, with massive job losses and the housing market collapse, was a direct result of those credit markets seizing up.
And we're still living with the policy tools that were created to fight that crisis. The decade of quantitative easing, near zero interest rates, all of that was born from the policy response to the Lehman shock.
And those decisions have distorted markets and fueled political polarization for 15 years.
So what did the surviving banks learn from that Sunday phone call? Was it to be more cautious?
You'd hope so.
Far from it. The ultimate lesson the surviving institutions learned was cynical, but it was effective. Become bigger, more complex, and more essential.
They realized the critical line wasn't drawn at size, but at interconnectedness.
Exactly. They made sure that the next time a crisis came, they would be unequivocally on the AIG side of the line, so essential to global stability that a backstop would be guaranteed, and they would never again be on the Lehman side, where moral hazard was the priority.
The world we live in today, economically, politically, with high debt, low rates, massive financial institutions, it was all forged in the crucible of that single high-pressure human decision on a Sunday night in September 2008.
The true turning point wasn't the dramatic bankruptcy filing on Monday morning. It was the quiet, determined phone call on Sunday night when Hank Paulson refused the guarantee for Barclays.
And our sources suggest, especially through the analysis of Lawrence Ball and the FCIC, that if regulators had just blinked, if they had found a way to treat Lehman like Bear Stearns, the immediate, terrifying cascade might have been contained.
The modern global economy was hanging on that one refusal, inches from an averted catastrophe.
This is the fragility thesis in its purest form, isn't it? Our complex global systems, they rest on these invisible hinges and on the specific judgments of exhausted individuals in a room.
The decision was born of political necessity and a deeply felt but ultimately misplaced desire to introduce discipline to the market. But it failed spectacularly because the true scale of systemic risk was completely unknown until the system itself was tested to its breaking point.
So we invite you to consider the profound fragility of these complex, interconnected systems. If a few tired people under intense political pressure could fundamentally re-engineer the global economy for a generation with a single transatlantic phone call, what other critical hinges is our world turning on right now that we aren't even aware of?
And next time you see chaos, remember the Lehman weekend and realize how close every complex system is to a catastrophic collapse and how much depends on the judgment of the few who are forced to make an impossible choice.
The complex world is built on confidence.
And confidence, as we all learned that Sunday night, is very, very easily shattered.
That's a deep thought to end on. Thank you for diving deep with us. We'll see you next time.